Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekouk.com, T-H-E-K-O-U-K, thekouk.com, and on Twitter using the handle thekouk. Stephen, good morning.
Good morning, Sean.
Now, look, there wasn't a lot of economic news out last week, apart from the Reserve Bank minutes, but wow, what a week for markets, pretty much thanks to the Fed.
Fed and even the Bank of England and others were hiking interest rates like crazy, I think it's fair to say. We all saw the big moves and the very hawkish commentary coming from Jerome Powell from the US Fed and even from the Bank of England, where there was a bit of a split in the vote of whether they went 50 or 75. Now, they ended up going 50 only, but there were three members of the voting panel that voted for 75. So a little bit of a dispute there. But the bottom line is clearly these central banks are absolutely adamant they're going to be fighting inflation. These rate hikes are taking rates to, I think, what most analysts will say are neutral, maybe even slightly restrictive. But given where inflation is, they're still pricing in more to come.
Yeah. I mean, as you mentioned then, the heads of these central banks are jawboning the need to absolutely clamp down on inflation and price rises.
Indeed. I'm old enough to remember back in I think it was the 80s or 90s, it was the debate was, is it inflation or growth? You can't have both in the current, as in low inflation and strong growth. So this is where it's again, dare I say it, the recession we have to have, that the central banks, certainly in the US, are saying, look, we're happy to grind the economy into the ground for the sake of getting inflation back under control. The best thing we can do is actually have inflation low and stable around their 2% target. And if the economy is still growing, it's very hard to achieve it. So basically, they've acknowledged, without using the exact words, that they're happy, in inverted commas, to have a recession to get this inflation rate back under control. And many other central banks are in a very similar position.
So just bringing that back to the Reserve Bank of Australia, we were only a week or two ago talking about 25 basis points, maybe 50 basis points. It seems the action from other central banks have convinced some market economists that it's more likely to be 50 basis points from the Reserve Bank. How much influence does what the other central banks do have on Martin Place here?
Look, it does have an influence. The broad thrust of policy, certainly the direction, but even orders of magnitude of rates are globally determined. And Australia has its own inflation problem too. We shouldn't forget that we've got inflation, according to the RBA's own forecasts, heading towards 8% by the end of the year. We've got the labour market still as tight as a drum. And because of that, we only have a cash rate of 2.35%. So this is where the discussion is, well, how much higher do rates have to go for us to get our inflation back under control? So it does matter what happens overseas. And again, the thing that happened last week in particular was the free fall in the Aussie dollar. It fell below 66 cents at one stage because the Fed was hiking and, maybe the RBA won't go as much. So, the Aussie dollar was under a lot of pressure late last week.
Dreadful time to go on holiday, Stephen.
To the US, it's a bad time. Look, the funny thing is it's a US dollar story. We're actually holding up. If you look at the cross rates, Aussie versus the euro, the British pound and the like, we're actually sort of treading water. We're not really falling. So it's really just everybody pumping money into the US dollar.
Now, come on, there's a story behind this because you are going to Europe shortly.
Well, I am. Next week, I'm off to Greece for a holiday. So this is my last week ahead for quite a while.
I know.
So I'm looking at the Aussie versus the euro, and it's been okay. So don't feel sorry for me when I'm on the beach in Mykonos having a Campari and soda.
I probably won't. What about this week coming up? Just, as you head off later in the week, what I hope you're not going to miss, though, is something you've been lobbying for a long time, monthly CPI data.
Yes, I'm thrilled. Just as a very quick background, 20-odd years ago when I was working at TD Securities, we funded with the Melbourne Institute of Applied Economic and Social Research an experimental monthly inflation indicator, and they replicated the ABS methodology as near as they could, and it's a useful indicator. It's still coming out, but I fear it's going to be superseded now because the ABS themselves, of course, in recent times have had their own experimental monthly inflation reading, and now they're publishing it. This week we're going to be seeing the month of July and August. They're doing 2 months in the one release to sort of give us a bit more of an indicator on how that momentum on inflation is going. So 3 cheers for the Bureau of Statistics. We're getting monthly inflation readings.
Yeah, when you get a new series like this, is it something that you just have to watch for 12 months or so just to see how it performs? Or can you kind of trade off the number that comes out this week?
Yeah, look, a really good question, which is why the ABS actually compile the numbers for a good year or two before they actually release them. They do their own testing. They don't just produce a monthly number and here it is, mark it, you go and work out whether it's a good or a bad one. So, in fact, last quarter, they released the monthly series with the quarterly data going back around about 2 years. So you can sort of see the volatility within the quarter. Obviously, 3 months within a quarter, you can get big jumps up and down with petrol prices and things like that having a big impact. So they tested already, but I dare say every market economist I'm aware of has been poring over it, having a good look to see just what we could make of the numbers when they come out.
A few other, bits and pieces really this week. One that will be interesting is the final budget outcome. And we heard last week Treasurer Jim Chalmers saying it'd be about $50 billion better than expected.
Yes, so they have to release the final budget number for financial year 21-22 by the end of this week. I'm not quite sure which date it's coming out, but we do know that, as you said, Jim Chalmers said because of what was a boom in commodity prices up to 30 June, a very strong labour market that was creating jobs. So when you've got a job, you pay tax. There was some evidence that wages were picking up. So when you earn more, you pay more tax, and spending was strong. So GST collections were also high. All that fed into a $50 billion improvement in the annual budget bottom line. So we're looking for a deficit around about $30 billion rather than the $80 billion that, the previous Treasurer, Josh Frydenberg, was forecasting back in March.
Though he did also warn, Dr. Chalmers also warned that it's kind of a one-off. Well, at least the commodity prices is a one-off.
Yes, and since that windfall, I suppose we could call it, we do know that commodity prices have fallen. So the iron ore, which was hovering at 130, 140 US dollars a ton, is now down around about $100 US a ton. So that's a bit of a loss of revenue, not only for the mining companies, but also for the government. And the economy appears to be slowing down too. So that it does appear to be a one-off. Look, you take it. It's fantastic. 50 billion is not the money you find behind the back of the couch. But I don't think it's a structural improvement in the budget. It was more basically because the Treasury got its forecast wrong and they underestimated revenue and overestimated government spending, which didn't happen.
Retail sales for August are also out. It's funny, during the last earnings season, some companies came out and said things have gone really soft since the end of June 30, the financial year. And other retailers I'm talking about, and other retailers came out and said, actually, things are pretty good. So what do we expect from the August retail sales?
The internal bank data on credit card transactions and like are pointing to a slower number. I think we have had the reaction of consumers to rate hikes and just the slower economy more generally. So the market's looking for about a flat outcome for August, but it just depends of how much coffee we've all been buying in that month and whether it's sort of just a temporary blip or whether it's the start of a trend lower in household spending. The RBA certainly think that in broader terms that the trend is lower for consumer spending.
And another couple of partial indicators, job vacancies will be interesting, and private sector credit.
Yeah, two little ones also of some importance. Job vacancies, which have been strong, a good forward indicator of how employment's going. Some evidence that there's a topping out. I wouldn't say a slowing, but a topping out in demand for labour. So we'll watch those. Private sector credit, housing slowing down, so credit for housing will be weaker. Business credit still seems pretty strong, though. Businesses are investing, so it'll be mixed news on that one.
So, Stephen, we won't be speaking to you again for a few more weeks. Is that right?
That's right. I'm going to be sunning myself in glorious Greece, but I'll certainly talk to you when I get back towards the end of October.
Yeah, we've got the wonderful Sherelle Murphy stepping in for you. Sherelle's at EY, another regular here.
I'm scared she's going to outdo me. Sherelle's a brilliant economist, so I'm sure she'll do a great job.
Stephen, enjoy the week, but have a great break. You deserve it.
Thank you, Sean.
That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.